The following program has been furnished and paid for by Kevins7 Financial Services, and KSEV is not responsible for its content or the products or services offered. Welcome to Your Finances with Kevin7 here on KSEV, a show about finance and retirement planning. And now, here's your host, Kevin Kugley.
Hello, and welcome to the Kevins7 Your Finances show. Today we will be talking about your finances and hopefully give you a fresh perspective that you haven't necessarily heard out there. We'll talk about what's been happening in the market, what's been happening in the economy, and what is Kevins7. So Kevins7 is a financial planning firm, and we work in all areas of financial planning, and particularly we focus on helping people have an income stream in retirement. A lot of people out there, they know about Social Security, they might have a pension, but aside from that, there is an income stream that can be provided for you once you have a financial advisor. Many different options that are out there, right, Gary? Can you hear me, Gary?
There we go. We're talking about you, and I had problems over here. Yeah, there's a lot of options. We found out what Kevins7 is. Where is your office, though? Do you have an office here in town, in Houston?
Yeah, we have one in town. It's over off of Post Oak Boulevard. That's 2200 Post Oak. It's just north of Westheimer. There's a Gallery Furniture over there, and we're right across the street from there. So people are welcome to call us and schedule an appointment if they'd like to meet in person. We also have an option downtown, and for people who are listening, farther east of Houston. We also have 2 offices in California. And so the show here based in Houston. I'm in Houston right now. Typically, though, Gary, we bring a lot of people on, and people don't even want to get out of the house and fight the traffic. We do Zoom calls. And I have an assistant, Susan. She's a fantastic tech person that can help people if they've never been on a Zoom call before. She can help them set their Zoom up prior to meeting with me. And it's a very helpful way for people who, obviously don't want to come into traffic. There's still some people out there concerned about, getting a virus, whatever. I actually just got sick myself and feeling better now. So
yeah, you sound.
There's huge advantages to Zoom.
You sound okay to me. Listen, I understand you work with Dave Ramsey a lot. Do you work with his steps? Do you take care of those steps as well with Dave Ramsey?
Yeah, so Dave Ramsey has a lot of content online, and he's got a radio show. It used to be here on KSEV, AM 700, and now he's on, I don't know if he's on XM radio or what, but he's on YouTube and Instagram and Rumble. You ever heard of Rumble, Gary?
Yes, I do. It's time to rumble.
Yeah, Rumble is essentially an alternative to YouTube. It's another streaming service. So anyway, Dave Ramsey can get, he's got the 7 baby steps, and we recommend that everybody, particularly for people that are beginning and looking at finances, and this can start as early as age, 13, 14, 15. These principles are fantastic. Number 1, you put $1,000 in savings. Once you get there, you move on to baby step number 2. That's pay off all your credit card debt. And then number 3, you put 3 to 6 months worth of income into a savings account for emergency expenses. So you have a slush fund, and in case your air conditioning goes out, right?
Oh, yeah, got to have
air conditioning. Is heavily needed this time. Yeah, it's it could go out at some point. You need to have that you need to have that in an emergency savings account. So that's baby step number 3. Baby step number 4 is this is when we usually look at sitting down with people or doing a Zoom call with people, is when people start putting money into a retirement account. And it's amazing, the earlier that you start putting money in a retirement account, the better off that you are in the long run. Dave Ramsey recommends you put 15% in any retirement account that you have. And if you have an employer, you're probably going to look at a 401k or a 403b. The technical name for that is a defined contribution plan, because you're contributing money, you as an employer, contributing money into the retirement plan. And if it's a traditional 401k or a traditional 403b, then you have the immediate deduction, which is fantastic. You can also potentially, if your employer offers a Roth, you could do a Roth contribution into your retirement plan. Automatic deduction from payroll, so it's very easy, and it makes it simple for people once they get on board with a company. It's the perfect time to set that up. However, if you're not at 5-10%, if you're at maybe 5-10%, take a look at it again. Call your provider. Your 401 Fidelity is a big player in this space. You'll want to put in 15% if possible. The more amount of money that you can put in. Yes.
It seems like there's a little delay here with what we're doing. I won't explain to the folks yet because you'll be going away, and we'll talk about that later. But you mentioned the 401k, the traditional,
okay,
and the Roth. Now I don't even know. This is how crazy I am. I'm in with the 401k here with my employer, but I don't know if it's Roth or traditional. I'm assuming it's traditional.
Yeah. So you have the potential, depending on the provider and if your employer, KSEV, now I'm not an employee of KSEV, obviously, but Gary is. So you could check out to see if they offer the 403B, I'm sorry, the 401k that's a Roth. And if they don't, we could take a look at that and work through that. Any employer, we can work through that with them so that they can have the Roth 401k as an offering to their employers. Because some people, they would just rather to put the money in after tax so that they don't have to pay income tax when they withdraw the money. And a lot of people heard of the Roth IRA, but they haven't heard of the Roth 401k or the Roth 403b. So depending on what you want to do, those are two options for you. So, yeah, we can check offline to see if KSEV does that for you.
We're talking with Kevin. Now, what's the difference between the 401k, the traditional, and the Roth?
Yeah, so the Roth is an after-tax contribution, so you don't get the immediate benefit like you would inside of a traditional 401k. The immediate benefit is that there's a tax deduction. So whenever you have, say, $100 that goes into your 401k, traditional 401k, $100 is $100, right? Whereas if you put money into a Roth 401k, if you're in the 25% income tax bracket, then they're going to have to take out that taxes. So $100 is not going to be $100 because you're going to have to pay $25 in taxes. So your Roth 401k contribution in that case will only be $75. Oh. Now you can raise that amount, but just know if you're in the 25% income tax bracket, you're going to have to pay that 25% going into the Roth. So that's deferred gratification because you're not going to see your 401k. Well, you're going to have to pay taxes on the money going in, right? But
right.
The deferred gratification and the trade-off is that you are able to withdraw the money with no income taxes, not a penny in income taxes. Here in the state of Texas, everyone has the fortunate ability to not have to pay a state income tax, right?
Yeah. Yes,
but
right.
if you were to move from Texas to, and I know you're from Ohio, if you moved from Texas to Ohio, which has a state income tax, and you were contributing to a Roth, you're not going to have to pay a penny in income taxes, even to the state of Ohio.
Ooh.
When that money comes out. You don't pay a penny in federal income tax, and you don't pay a penny in state income tax. So that's a huge benefit for people who are, it's a bigger benefit for people who are obviously retiring in an income tax state, or a state that taxes people on their income.
Now, you mentioned...
Make sense?
Yes, it does. It makes sense. You mentioned the 401k. You said something at one of the shows previously, show about the 401k, that I'm over 70 and a half. Is there something, when I pull out, there's going to be, what is it, some type of a tax? Once you reach 70 and a half, it's you got to pay more money?
Yeah, not while... Exactly. Good memory there, Gary. So whenever somebody has their money in a retirement account that is a traditional retirement account, doesn't have the name Roth attached to it, right? Whenever they have money in that account, if they are not working at age 70 and a half, that was the age in the past, and now they've upped it to 73, right? This is a new thing that came out in the Secure Act 2.0 last year. So whenever that money, whenever somebody hits the age of 70 and a half, right?
Right.
Or 73. See, the number changes. It confuses everybody.
Wow.
So whenever you hit the age 73, if you're not in it's a RMD. So that's a required minimum distribution. In the past, there were significant penalties for an RMD, but now not so much, right? They backed off, the IRS, with Secure Act 2.0 that was passed into law last year. They made the penalties not as stiff, which is a good thing, because a lot of people don't know the RMD, required minimum distribution amount, or they don't know they need to do it. But now, so you're still working, or anybody who's still working, you're actually eligible to roll over a 401k or a 403b into an IRA. So usually whenever you continue to work, you continue those contributions. If you're not going to retire and you're beyond the age of 73 in this case now, then you more than likely just keep your money going in and keep it there at the 401k, so you don't have to do that RMD if you roll it into an IRA.
That makes sense. That makes a lot of sense. I'm Gary Knight with Kevin7. Kevin, I'm going to take a break now. Why don't you come into the studio now, and we'll go from there in just a couple of minutes, okay? So you're listening to Kevin7 right here, a little Dixieland, and listen carefully.
Give me a whirl on a Tennessee Saturday night. Lucky as a 7, living in heaven with my Dixieland delight. Spend my dollar, park in a holler, neath the mountain moonlight. Hold her up tight, make a little loving, a little turtle doving on a Mason-Dixon night. It's my life, oh so right, my Dixieland delight.
Having a hard time knowing what kind of income you may expect in retirement? Kevin7 is a financial planning firm. We take you from financial confusion to financial confidence. A financial plan takes into account what you're making, spending, and saving, and forecasts that into the future. Call us at 877-KEVIN7. That's 877-538-4677. We can schedule an appointment for you via Zoom, phone, or even in person. Or visit us on our website at kevins7.com, Kevins, the number 7.com.
Catch Chris X Radio weekdays at 4.
When referring to the summer heat wave, Hillary Clinton tweeted out, "Hot enough for you? Thank a MAGA Republican. Clearly it's global warming." It must be true if you ignore 1925, the 30s, the 50s, 1980, 85, 95, 2012, 2020. Weren't we supposed to be dead already?
Chris X Radio, weekdays 4 till 6, right here on the Voice of Texas. Phone lines are open now. Call 281-558-5738. That's 281-558-KSEV.
Oh, Rocky Top, you'll always be home sweet home to me. Good old Rocky Top, Tennessee.
Hello, and welcome back to Your Finances. The firm's name is Kevins7, and I am Kevin. We'll talk a little bit about what happened last week in the market. We spoke on the last show about Alphabet, or the company that owns Google. You remember that?
I sure do.
Yeah, you asked me if the earnings were going to be positive, and well, nobody knows the future, but I said it was going to be bad if Google had 2 quarters negative.
What
because
happened?
their previous, it was up big time. So they beat earnings. So now Google owns YouTube, right? And YouTube is absolutely monstrous.
Oh, yeah.
Monstrous. Huge company, right? Just within Google. Google's now, they've got 3 billion customers, if you can believe that. That's just...
I mean, look at the employees list. There's hundreds of thousands of them working and running around.
It's unbelievable.
Is that out of California?
What's
Google?
that?
Are they? You're referring to?
Yeah, they're up in the Bay Area. They're not far from Apple, their major competitor, actually.
Wow.
And it's actually, I think it's undervalued compared to Apple. The PE ratio is lower. So the PE ratio for everyone, that is price to earnings ratio. So you take the price of the stock and you divide it by the earnings per share, and then you have what the PE ratio is. And the lower the PE ratio is, the lower the more value supposedly. And all this is theoretical, right? Whenever you hear these stock formulas, they're theories. Nothing is guaranteed. Oh, this formula, you got to go by a PE ratio because, you know, this company, Google, if you would have Alphabet, it didn't have a PE ratio when it first started because it didn't have any earnings.
Ah, makes sense.
So it was purely a growth stock. So now it's obviously a huge company. It's got 3 billion customers from Android. You know, the majority of people in America use Apple iPhones, and there are quite a few Android users, but there's over 3 billion Android users. And
Wow.
Google Alphabet is owned by... owns that they do Android. So their stock for this past 5 days is up 8.81%. So yes, they beat earnings. Google beat earnings. And the day that they announced was Tuesday night, actually. Their stock shot up Wednesday over 5%. So yes, earnings make a difference even in the short run.
I got a question
Yeah.
on Google stock that you mentioned stocks. I don't know if you remember when they first started. What was it per share, and as it is today? Has it gone up dollars and probably hundreds of dollars?
Oh, yeah. If you would invest something like $100,000, I looked at this calculation. I don't know if it's perfectly correct, but if you invested $100,000, by the way, guess who invested over $100,000 into this Google stock when it first came out? It was Bezos. He did
Jeff?
he put a lot. Yeah, these companies are pretty interconnected. Jeff, who actually, by the way, is a Houston guy. You know, he went to River Oaks Elementary School.
Oh, really?
Yeah.
Wow.
So he bought into Google. You know, they used Google, and so they were interconnected. And just I looked at this calculation a while back, and it was astronomical. If you would have gone into Google whenever it originally IPO'd, and I was with Merrill Lynch at the time, I'm like, oh, yeah, this is a cool company. Never heard of anything like it before. I want the IPO. They didn't actually have underwriters from traditional investment banks. So Merrill Lynch didn't get an allocation back then, and I don't remember what year it was. I think it was the late 90s sometime. So that stock, they went around the investment bank, but they issued the stock, and man, if you would have invested $100,000, that stock would be worth over $100 million, something close to it.
Really?
Last time I saw it.
Well, how long has it been now? How many years have they been doing this?
Yeah,
20 some years?
Yeah, late 90s.
Okay. Well, that's a lot of money.
Yeah. So, yeah,
Amazing.
we're in 23. So at least 30 years around there. So, but again, a lot of this, that would have been luck. But the main theme that this comes back to whenever it comes to now this is exciting when you talk about a stock that's performed as well as Google over the last 30 years. But the main thing is whenever you look at this, remember, if you're an investor out there, that patience is key. Wait on the stock to perform over the long run, over many years, with a diversified portfolio. And by the way, Kevin7 is 7 different stocks. That's just the stock portion of our portfolio, right? So
Right.
the 7 stocks, right, I wouldn't go out and buy, particularly, the older you are, but even younger people, I wouldn't recommend going out and buying just one stock. You need to have at least a diversification of 7 different stocks. And
A balance there, too.
so this is kind of like, it's balanced, and it's kind of like its own mutual fund. The problem we see with mutual funds, and why I don't use them for stocks in particular, is that they are over-diversified. So you'll see 25 stocks, and over-diversification just makes an excuse for ignorance. And it's a Noah's Ark way of investing. So you don't want to sink your ship with trying to put everything in there. And oftentimes people have multiple mutual funds, and we see this. I've seen statements with people who've come in after, doing a seminar or a radio show like this, and they've come in and they've showed me they've got 25 to 50 different mutual funds. So
Wow.
they're way overly diversified. And
Is that good?
no, it's bad. It hurts. It destroys returns. That's why we keep it simple at Kevin7. We have 7 stocks that we move clients into, and those 7 stocks act as its own mutual fund. So that's why quite frankly, I think that's why we've doubled the S&P 500. If you go back like 15 years, you can see the performance is just blown away. And if anybody would like to see that, they can always call my assistant and get on my calendar. It's 877 Kevins7. That's Kevins, the number 7. That's 877 Kevins7. We can schedule a Zoom call, and I can show you the performance over the past 15 years. So, but, like in a 401k, you don't have the option to go into individual stocks. So, like somebody that has a 401k, if they're before the age of 59 and a half, now after the age of 59 and a half, we'll take a look at rolling it over, and it might be a potential benefit for the person. I've done that before, and the clients have been ecstatic, particularly over the last year since the Kevin7 has done so well. So whenever you have a 401k, if you're far away from retirement, the S&P 500 or some type of investment like that is the best way to go. And then as you get closer to retirement or using the money, right, you want to back out of stock type investments because they're a little bit more risky, and then moved into something that's more principal protected, right?
Now, you mentioned Google, right? They're the ones that went up, right? Like you said, they were going to go up.
Yep.
Now, does that help the economy? Is there an indicator there, and how are the markets looking?
Yeah, well, it's Google, and there's a tech rally going on, and there's something called an RSI, or Relative Strength Index, that a lot of technical analysts who look at stocks on a daily basis, they refer to this Relative Strength Index, and they look at moving averages. So if a 20-day or 100-day moving average, they'll look at a chart, and if the stock has jumped up above its 20-day, 100 moving dollar average, then they're going to say, hey, this stock might be overbought. So Google, some of these tech companies, a lot of them, in fact, are the main drivers of the S&P performance right now. So the S&P 500 it was up 1% for last year. I'm sorry, for the previous week. And the major part of the S&P 500, 30% of that are in tech stocks. So it is essentially, you've got the tech section of the of the stock market. It might be a little bought, but it's been on such a tear, particularly with 2 or 3 stocks that released earnings over this last week. It's been on such a tear. I'm not feeling that I'm going to withdraw the money that we have in the Kevin7 out of the tech stocks, because it's just been so fantastic lately. However, there is, I'm looking at this closely on a daily basis. So that Google, at some point, I might pull the trigger on the tech stocks and say, hey, we're out of here. Oh. But getting back to your question, you were talking about the economy and how it affects America. I mean, it really affects Silicon Valley and those areas more, because there's so many employees that work there. Whenever their stock goes up, that does really well. But let's face it, Google or Alphabet is a huge, mega, global corporation. And so this is like world economics when you're talking about the stock. Now, still, America is number one country on earth, and I don't think that's going to change in my lifetime. And remember, I think one of the shows we talked about the 4th of July, how, in the 80s they said Japan is going to take over economically. Then
I remember.
Remember, just like 4 or 5 years, the last 4 or 5 years, oh yeah, China is going to take over economically. China right now can't even get their economy out of the dump. They're trying to reignite it any way they can. So they lock down their people, and then it's just like the American economy. I was severely concerned when the leaders of this country came out, we're going to shut down the economy. Because you take you know how much power it takes to lift a 747 off of the ground? And that's just a small inkling, a 747 analogy to the American economy. So the 747, if you're cruising along, it doesn't take as much power. You land that thing, and then you try to take off again, the 747, it's going to take an enormous
amount of lift.
Yeah, it's so you essentially, thankfully, we're starting to come out of this, and we can talk a little bit about inflation. By the way, I hear a lot of economists out there, and they're talking about, well, yeah, inflation's coming down. No, inflation is not coming down. It's decelerating. So it's not the inflation is not going down. Last year we had 9% inflation, which was the highest that we've seen since the 80s or 70s, right? So.
Have you heard this one? Not to interrupt you.
Go ahead.
I heard this on one of the talk shows about 2030, due to our taxes that we're in debt. I mean, it just goes on the trillions and trillions. Right. We could go into a depression by 2030. Do you believe in that kind of stuff? Yeah. I don't want to scare anybody, but.
Yeah, no fear. We don't fear. So we're not going to scare anybody, and I don't ever want anybody to come on as a client because they're afraid of something. We are very optimistic and very positive about the American economy. There's something called FOMO out there. You know what FOMO is?
No.
It's called fear of missing out. So right now the stock market's on a tear. It doesn't matter if you're scared of the economy. Fear is, I think we're talking here on Sunday, right? The Bible says over 365 times it says, do not fear. So I think you got one for every day of the year. So fear of staying out of the market, fear of getting into the market because you're going to miss out. Those are usually wrong motivators. And again, it goes back to, using the basis of everything that you do as far as investing. Again, we talked about using Waze or Google Maps to get to your destination. Have you ever used Waze, or you use Google Maps, or you don't use it either?
Yeah, I've used Google Maps before.
Yeah. You just plug in the direction, and it'll tell you where to go. That's what a financial plan does. And so it's not based on FOMO, fear of missing out, whenever you invest. It's based on the financial plan. It's not based on the fear of the economy when you heard from your neighbor that, oh my gosh, the American economy is going to go down in 2030. And I think a lot of these exaggerations are overblown. And the people who have I've heard, I've had friends of mine 15 years ago, they were saying, oh, the economy is going down. Well, it's just, I never have heard of a successful pessimist. It's always good to be, you got to be a realist, right? But it's more often than not, it's better to be an optimist. And the people who are the optimists when it's in regard to the stock market, and they are patient over a long period of time, they wind up being wealthy beyond what they could think. But the key is staying patient, staying in. The market timing does mean a lot when you get in and when you get out, but staying in it, because that's going to affect, let's face it, let's be real. Whenever you get in or out of a stock, it's going to, that matters, right? But over a long period of time, it's better, right, to be patient, and that is going to have a bigger driver of your overall outcome than just whenever you get in or out of the market.
I mean, it's good to be a risk taker. I mean, there's always a risk in anything you do.
Yep. There's a risk getting out of bed in the morning, right?
That's right. You never know.
But, optimistic, and this is the way people have been successful. And it blows away real estate. The stock market, the S&P 500, and I've been around some high appreciating. We talked about, we have got a couple of offices in Southern California. That real estate has just skyrocketed. And still, the S&P 500, which anybody, anywhere in America can participate, it way outperforms the real estate market. It's not even close. And then, don't forget, if you're in real estate and people come to me and go, well, should I buy this house as an investment property, second home? I said, have you ever done this before? No. Well, have you ever managed a property? No. Well, do you know that it's a depreciating asset? What do you mean? Yeah, the real estate, the building on the real estate property is a depreciating asset. Don't forget that whenever you go to hcad.org and see your price, and then you go protest your taxes like you have to do on an annual basis, then you tell them the building has depreciated, because it has. The thing that they offset that with, and the computer comes up with a number for you to say, hey, it's appreciated. That's based on the land value. Whether it's correct or not, that's what you need to do, and whenever you're looking at protesting your property. But again, so we talked about, if somebody's not invested in real estate as their full-time job, I wouldn't recommend doing it as like, I got, some extra cash. I want to put it in a second property. I want to buy some apartments, something like that. Unless they've done it for, a career, I wouldn't recommend that. In particular, and another thing about real estate is it's more difficult during an estate, whenever somebody has property go into probate. Oh. It's pretty simple, but if a client dies and they have stocks, the financial advisor can tell you exactly what the stock was on the date of death, and there's no fighting between the heirs. Real estate property, how do you know? What, are you going to go by HCAD? Are you going to go by what the real estate agent thinks it is? So in that case, you probably need to get 3 different real estate agents to tell you what they think the property is valued at, and then it sits with the parent's property. In most cases, it sits there and it's not sold upon the second death of the parent, and you're paying land taxes on it again. I think I made a case for stocks over real estate, have I?
Oh, yeah, Kevin7, a financial advisor, a financial planner, Kevin7. You say Kevin7s, there's no comma. It's 7 and then the S.
Yes,
right after it.
Kevin, the letter S. There's no apostrophe, right, in a website, so it's just Kevins and the number 7. So it's Kevin7.com, and it's also 877 Kevins7 with the Kevins and the number 7.
Oh, time to break, somebody said. Okay, we're going to be right back. Talk more. I'm having fun today, aren't you?
Absolutely.
I'm gonna drive my daddy's Thunderbird, white red ride, 66, so glam, it's absurd. I'm gonna put her in the backseat and drive her to Tennessee.
There are 3 things you need to know when choosing a financial advisor. Number 1, experience. Number 2, credentials. And number 3, judgment ability. I have over 27 years experience in the industry. I am a chartered retirement planning counselor, CRPC, and an MBA. Although past performance doesn't guarantee future results, we can show you that we've delivered results that double the S&P 500. Don't hesitate. Call us at 877-KEVIN7 or visit us on our website, Kevins, the number 7.com.
While the Biden regime, from the DOJ to the FBI to the White House, the Biden crime family, and left-wingers in general, enjoy being able to break the law with impunity, President Trump facing down another indictment. The good news is the polls show the American people see right through this. Not only shouldn't we accept the two-tier justice system, we sure as hell shouldn't fund it. We discuss on the next Chris Salcedo Show. See you at 7 after Lance on AM 7.
Phone lines are open now. Call 281-558-5738. That's 281-558-KSEV.
Hello and welcome back to the Kevin7 Your Finances show, where we're trying to show you some things that you might not have heard about, give you a fresh perspective, and obviously talk about the markets and the economies.
Let's talk about what we were talking about. I forgot the letters you gave me already, so...
Yeah. So we were going to talk about CBDC.
There it is.
Yes, that's central banking digital currency. And this is something that a lot of people are concerned about. In fact, you now have politicians that are coming out. I think it was DeSantis said he will absolutely not allow CBDC to happen. So it's a form of digital currency. It's issued by a country's central bank. The concern here is that the government would have more control over what's in your bank account. And in China, for instance, there's a way that people can be issued money into their bank account, and then they'll put a time limit on it that if you don't use it within a week, they will make it disappear.
Oh, really?
So it's a way to stimulate the economy. So it's very brand new. It's on the horizon
It seems
potentially.
to be working, right?
Huh?
Seems to be working.
The CBDC? Well, it's a concern because people don't necessarily want the government to be able to do these sorts of things in their account. So it's not implemented yet. So there's a lot of education that needs to be done to the public. And then there's also, these politicians, they will come out against it like DeSantis already has. And the most people listen to this station, 700 AM, I'm sure they think it's not necessarily a good thing. So that's what CBDC is, central bank digital currency, right? So right now, the Fed is a fiat system, and we can talk about the Fed in a moment. So they have the U.S. dollar is not on gold, obviously, anymore. And then so what they can do, they can just issue cash or create cash, the Fed can. And that's how they manage these interest rates. So interest rates went up on Wednesday of last week again, and they are saying, they being the general market followers of the Fed funds rate, and the futures contracts. There's actually a futures market that people can buy into for the Federal Reserve rate. It's appearing now that they're on a pause. So there might be one more Fed funds raising the rates one more time before the end of the year, and then potentially they might even pull back and cut it. So, by the way, there's something called Fed Now that is new that it has implemented into action. And it's kind of like Fed Now is kind of like a behind-the-scenes kind of thing that your bank can use. So I move money quite often. I can move money obviously I have to have them on the line or live with me on a Zoom call. I can move money from a client's account, their checking account, to their brokerage account or vice versa. That is called an ACH, Automatic Clearinghouse Transaction. So if their accounts are linked, their brokerage account and their checking account or savings account or credit union account, it doesn't matter. We can move money back and forth between the two.
What would be the reasoning behind that? Why would you do that?
Because just like we said, you don't want to pay taxes on money that you're not using. So you want to put the money in a brokerage account, get your higher rate of return. We can do CDs. We can do these structured notes that we've mentioned on this show. There's a lot more alternatives rather in a brokerage account than having just a standard bank account. So we can do it. And by the way, if somebody has those RMDs we're talking about, we have that money go out automatically out of their IRA to their checking account. So that also is an ACH transaction. So ACH, Automatic Clearinghouse, as long as you get your transaction in before 4 p.m. Eastern time, that money will settle in your bank account at the end of the day. If you do it after 4 p.m. Eastern time, we can enter the execution to do the ACH, but it won't be implemented until the end of the business day the next day. So ACH, there's a lag time, right? Because the money doesn't show up until the end of the day. Even if you get it before 4 or after 4, you might potentially have to wait over a day. So what is Fed Now and how does that work into it? Fed Now will allow your bank, again, this is a behind-the-scene instrument that a bank can use. Fed Now will do it immediately. So you can, instead of doing an ACH transaction where you have to wait until the next day or the end of the day,
right?
Fed Now, boom, you'll see it immediately credited to your bank account. And so this is brand new. They just started Fed Now. So it might take a year or two for most banks, and some of the bigger banks are already on board with it.
But to me, I don't know much about it, but it sounds like a good deal.
Well, it's good to always have access to your cash, I think, and be able to move it to wherever you want. A lot of people are using Zelle these days, right? You've seen Zelle?
I've used it with my daughter up in Texas. It works nice.
Yeah, you can, as long as you have their phone number, then you can use Zelle. It goes straight from your bank account to anybody's bank account.
In less than a minute.
Yeah, in less than a minute. So really, that's not what's happening, though. The cash isn't really showing up in there. It's just an agreement between the banks to make it look like that, right? So this will make Zelle or things like that more efficient, right?
Right.
Same thing with in the old days, Venmo and PayPal. Now everybody's using Zelle. Same thing. So
PayPal, I remember PayPal. Wow, it's like a turtle.
Yeah, that one not very popular for some of the things they did back a couple of years ago. But Zelle, you got the backing of your bank, and it works very nicely. So Fed Now is a way that you'll see the ACH transfers. I guess the most rather than that ACH moving it between two different institutions, it will be immediate, right? So that is Fed Now. And there's also something called SOFR that is brand new. It just came out this year.
How do you spell it?
SOFR.
Oh.
SOFR. You ever heard of LIBOR?
Yes, LIBOR.
Yeah, LIBOR.
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 LIB.
The London Interbank Offering Rate.
LIBOR.
So anybody listening, the cheapest money that you could ever go borrow was traditionally LIBOR money. It's way less expensive money, meaning the interest rate is always lower on a LIBOR than it would be the prime rate. So LIBOR was a very low interest rate. You would usually pay, if you go get a loan, you pay LIBOR plus 1 point, depending on if it's a 3-month or the 6-month. So SOFR, they did away with LIBOR. You know why they did away with LIBOR?
I can't think of it right now.
So they did away with LIBOR because people were manipulating it. And so all of these banks, if you ever have anybody listening, go check if you have a loan that was LIBOR, go check it out. And you'll be able to see that your LIBOR is now something called SOFR. And the SOFR, S-O-F-R, that's another acronym. It stands.
I love those.
Yeah, LIBOR, SOFR. So SOFR, the secured, SOFR is the secured overnight financing rate. And essentially, you're probably not going to see much of a change in the interest rate on your LIBOR after it's moved to SOFR, S-O-F-R. But it's something that you need to have in the back of your mind so you know. And you probably, the banks and institutions or the lenders can never go change something, without telling you. You probably, in all that documentation you receive in the mail or by email, you've probably already received notice that your LIBOR rate changed to SOFR. So it's still, now that LIBOR is gone, SOFR should be the least expensive way for somebody to borrow. Again, way less expensive than prime. So that is SOFR, S-O-F-R, something new that came about. And London Interbank. I talked to a friend. He goes, London? He goes, I don't know about that London. He goes, I'm glad they kind of got off of LIBOR. So, so this is a purely American rate, and it can't be manipulated by the market, supposedly, and that's why every institution is switching over to SOFR for lending.
We're talking to Kevin7, and this is Gary Knight. I'm enjoying all this new stuff every day. We're talking about this, and we didn't get to it last week's show, about the difference between fundamental and technical analysis. Do you remember?
Yeah. So we actually hinted about that earlier in the show, where we talked about earnings of Google. So earnings, that. Okay. Yeah, earnings were fantastic for Google Alphabet, and so that's a fundamental analysis to see what their earnings are, right? Whereas technical analysis, they're looking at trends and they're looking at charts. So another way to look at it is the way I've heard it explained, that whenever you're looking at stocks or the stock market, both of these are blended together, by the way. I would say fundamental and technical analysis, they
go
both
hand in hand. Huh?
Yeah, they go hand in hand. They're not as separated as much as people would think. It's kind of like if a fundamental analysis is when you're driving and it's raining at night and you don't know where you're going. Again, I like these car analogies, obviously. Financial plan is Waze or Google Maps. And so whenever you're looking at the stock market, you're driving, it's at night and it's raining. Your headlights are the fundamentals. So you're looking farther out. And then you look at the trends. You can see short-term trends or long-term trends. That would be your windshield wipers. So you need really both whenever you're driving your car on a rainy night, right? So that you can see where you're going. So it's very important to have a financial advisor who is looking at these. the technical analysis versus the fundamental analysis. If they're hands-on managing their stock, like we do at the Kevin7.
Yeah, a lot of people don't.
Right. So that's the market. This can be done with a little bit with debt too. Debt is more technical analysis. Companies, corporations can issue debt or bonds, and technical analysis even comes into play with these debt or bonds that corporations issue, and they also come into play looking at these treasury rates, the U.S. treasury rates. We look at those 10-year, 2-year, and the 10-year treasuries. So that is all with different markets, the stock market and the bond market. That's fundamental and technical analysis.
Now, do you use, it just slipped my mind, mutual funds?
No, we don't use mutual funds. There are some things that we use that are sold by prospectus. Now, I can't say never, because there's something called a separate account inside of a variable annuity, which it's a quasi mutual fund that's inside of the variable annuity. And again, I'm a big believer in not paying taxes on money that you're not using. So if you're not using the money, you can put it in a package called a variable annuity, and it's variable means going up and down. So those would be quasi-stock mutual funds that are inside of the variable annuity, right? And then you have mutual funds inside of some retirement accounts. Sometimes you have to use mutual funds, but we try to keep it simple. Again, for somebody who's 5 years away from retirement, we look at an S&P 500 type of a mutual fund so that they will get the growth that is delivered by the stock market. So that's when we do use mutual funds. And I was talking about the other thing that we sell, or our firm can do for clients. It's called a structured note, and it's a fantastic way to get in and diversify your portfolio. And some of them are 100% protected, meaning the principal cannot go down. Some of them have risk exposure on the downside, and that will the 100% principal protects. It's going to everything's a trade-off, right? So the principal protection will limit your upside participation in what the S&P 500 does. This is inside a structured note.
That's interesting. We're out of time. We got 30 seconds to make use of them.
Yeah. So again, there's a lot of concepts that we've had and talked about. Feel free. We've got this on Facebook, Kevin7, and then we also have an Apple podcast on Kevin7, so that you can go back and refresh. This is our 7th show, Gary, by the way. Did you know that?
15 seconds. I love it. It goes fast. It seemed like only 1 or 2 times.
It's fun. We love talking on the air, and feel free to call us at 877-KEVINS7.
Thanks for listening to Your Finances with Kevin7. If you have a question for Kevin during the week, you can give him a call at 877-KEVIN7. Or you can email him at KEVINS7.com. And tune in again next Sunday at 1 o'clock for Your Finances with Kevin7, right here on KSEV.
Kevin Kugley is a registered representative with securities and advisory services offered through LPL Financial, a registered investment advisor. Member FINRA SIPC. The opinions voiced in this show are for general information only and are not intended to provide specific advice or recommendations for any individual. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a decision.